Briefing started. Good morning, hope you're all well. Final day of the week. Let's just have a quick look. I think quite a tricky session in many ways yesterday. One thing of note, and we start with, let's say, the equity space. Let me try and bring up, I'm going to put a 240-minute chart of the S&P, which is quite a remarkable chart, given that we've got nicely encapsulated here this rally, this Trump fueled, fiscal stimulus, hope driven upside. What was it? 7 days in a row of new highs and 7 days in a row of new all-time highs, but it came to an end yesterday, and we pulled lower. I mean, it's not like we sold off sharply by any means, but we had a day where the actual index finished down on the day, and that hasn't happened really since you go back to the beginning part of February. So, and perhaps the irony is that it came on a day where we had, I think, one of the best US economic data releases I've seen for, years maybe. Well, maybe that's a bit strong, but this is the chart of the Philly Fed number, and this is the Philadelphia Fed. I mean, this is a sentiment survey, so you've got to take it with a pinch of salt. This is how people are feeling rather than measuring, actual output. This is soft data, not hard data, but still, you can obviously see that business leaders in the Philadelphia sort of manufacturing space are wet at the whistle of some Trump action to oil the cogs of their industry, and so you've got a Philly Fed reading that came out the highest since the 1980s. Look at the x-axis here. This chart's several decades long. You're going back to the 1980s to find a print higher than that. Things are relatively quiet, which is obviously a notable piece of information. But if we go flick back to the S&P, of course, what happened, if we go to a 15-minute chart now, just to zoom in a little bit on the price action from yesterday afternoon. So when we actually got the data, which was at 1:30, not much happened. Then we drifted higher. We had a go at the cash open, just punching up and trying to continue and extend this run of form on the upside, but it very quickly failed, and then we just tipped and down to the pivot. It's a real mess around the pivot level, it has to be said. Before then, 345, clean break lower down to S1. Then things settled, and actually we drifted back, and by the time we got back to the close, we're actually almost back to square one. I mean, it's pretty much a flat day for the S&P, although officially it was a down day, but we're talking about minor percentages. So, this is where you've got to understand, I think. Two things to say about this. Number one, huge data release, and you're thinking, well, all right, let's assume this uptrend is going to continue then. Let's say that this is powerful enough in terms of good news to see this rally continue. I mean, I don't think you can, or I can sit here and tell you that after that data release, I would expect the S&P to sharply sell off, and that actually didn't happen. We did push higher. I'm perhaps not surprised in the end, looking back at yesterday's session, that we got downside in the afternoon, because we're almost into the news is that data, it's almost too good from the Fed point of view. I mean, I know the Fed aren't particularly monitoring Philly Fed data to make their rate decisions, but that Philly Fed number, just get in line. We've had some huge data releases out of the US, and most notably the inflation numbers earlier in the week, and that's precisely what the Fed are monitoring. So, I think we've had a nice pile of punchy US data being delivered, and the chances of a March hike have actually substantially gone up. They're still below 50, but it's only just below 50%. I think we're like mid-40s now in terms of likelihood of the Fed hiking in March. And I think, in the end, that's just perhaps been the catalyst for profit taking more than anything else. This isn't quick sell-off panic, the Fed are going to hike. This is, go back to a 4-hour chart, we've had a phenomenal run here, guys. All right, chances of the Fed hike are edging higher. Let's play it safe and lock in some profit. That's kind of what that trade is yesterday afternoon. There's no panic sell here. And when you draw a trend line, then technically, we're trading pretty. I was going to say technically we haven't broken it yet, but actually this candle we're forming now looks like we might be just edging through this trend line. I mean, certainly the key level I would say for today is that low point that we had yesterday, which was a move that saw us hit S1 that was nicely on this trend line. So keep your eye out for that. It's pretty much the same today in terms of being S1. The pivots are pretty much, the pivot and S1 are very similarly located. So that's a key price point around 23.37. All right, so that's enough on equities. The dollar, I think, was quite interesting, especially when you look at the euro against the dollar. And again, it's quite counterintuitive because you've had some phenomenal data yesterday. And if we zoom in a little bit on a 15-minute chart, let's say, let me just find. Let's just get rid of that line. So where are we? Yesterday afternoon, around about 1:30. Here we go. You can hardly see it in here, but that's that data release. Virtually no action at all, you would say. The euro dollar was trending higher anyway. We dipped to find support at R1, and then the euro dollar just carried on doing what it was doing before, which was trending higher. So you had no dollar strength off very strong US data. And again, you've got to be conscious of the medium term here because the dollar had strengthened. This is a 4-hour chart, 10 days straight, 10 days in a row of new highs. Great run for dollar strength. And what's happened here is you've seen like a reversal, let's say a break of the low point we had end of January, for example, just being the trigger point for more profit taking. People are looking at this. They're long the dollar, if you like, by being short euro dollar. They're playing the inflation data, the strong US data. They're playing the Trump comments about fiscal stimulus, his use of the words phenomenal, enormous, it's going to be amazing kind of language to describe his fiscal plans. And great run on the dollar, and now we've got some profit taking. I'll talk about the euro in a minute because I actually think, I don't know. It's tricky. I was going to say this might be some euro-related issues in here, but actually what I'm going to say about the ECB in a minute perhaps doesn't stack up with that. But look, I think technically we've just seen definitely a break of that 10-day winning streak yesterday on the dollar, and the dollar, we just saw some profit being booked. That's what it was about, even though we got strong US data, which makes it a bit counterintuitive. All right, let's look at a few things, and then we'll come back to the charts in a minute. A few things to talk about. Let's talk about the Fed. We've had the FT. I'm going to switch up the screenshot here. We've had the FT and then Deutsche Bank this morning talking about the Fed. I'm talking about the Fed members. I'm talking about the Board of Governors, more importantly. So the way the Fed works, there's actually 7. Is there 7 Board of Governor positions? And is it 7? Yeah. There's 10 on the FOMC, right? That's the 10 people who vote to change rates or not. As far as I understand it, and Ant's going to confirm in a second, I think there's 5 permanent Board of Governors at the moment with 2 spare seats. So you've got 5 Board of Governors. They don't rotate, all right? They're permanently on the FOMC committee. And then the other 5 rotate every year. These are the other kind of regional Federal Reserve heads, and every year they rotate on and off, okay? But the Board of Governors are permanently there. So there's 5 at the moment. There are 2 spare seats, okay? And there's been spare seats. That's seats that have not been filled for a few years, and we think it's probably because Obama wasn't able to or didn't see any point trying to suggest a candidate to fill any of these two seats, because ultimately there was a Republican Congress, and if Obama tried to put forward a kind of Democratic-leaning candidate, then of course Congress would have shot it down, so he didn't bother. So we think that this obviously has changed. Trump's president, we've got a Republican Congress, and so there's a chance you might see Trump move to fill those two seats. And then there's another guy on the Board of Governors called Tarullo, who's resigned, and he's stepping down in April. So there's actually going to be 3 seats available on the Board of Governors. Should Trump choose to try and fill them, then actually he could shift the makeup of the FOMC pretty dramatically. What we're looking at here on the chart is the last time we had movement on the Board of Governors, and actually this is talking about the Fed president, the Fed chair, and this is where Janet Yellen came into office end of 2013. Ben Bernanke. So Janet Yellen's term finishes at the end of this year, start of next year, okay? And so we're going to need a new Fed chair unless Trump decides Yellen's worthy of staying, which I find highly unlikely. So you're probably going to get Trump also not only able to fill 3 seats on the Board of Governors, but also perhaps install a new Fed chair. He could install 4 new governors, plus including the chair, over the next 10 months or 11 months, which could remarkably alter the makeup of how the Fed do business. So the last time we had the Fed chair change, we had a bit of a taper tantrum 2013. Larry Summers, don't know if anybody was around trading at this point, but Larry Summers was in the offing as being the new Fed chair. Obviously, in the end, he didn't. He pulled out of the race in September, and then in the end, it went to the vice chair, which at that point was Janet Yellen, and Bernanke stepped down, and we got Janet Yellen. One thing to note, here's a chart looking at how the Board of Governors, how many of the Board of Governors dissent from the issued monetary policy directive. Remember, there's 10 people, and they've all got their own individual opinion, but in the end, the Fed deliver a decision that's based on the consensus, right? And this chart's looking at how many Fed governors have dissented and have got a different opinion from the consensus. And look at the black bars. The point of this chart is, really, for the last decade, 2 decades, governors don't dissent anymore. But is this going to change with Trump throwing in some curveballs and some sort of interesting candidates? Are we going to see the Fed less unity within the Fed, less, the days perhaps of unanimous decisions might be coming towards an end? Who's he going to perhaps propose to be new Fed chair? Well, it could be anybody, but here are 4 candidates that are currently being talked about. Kevin Warsh, who was on the Board of Governors 2006 to 2011. He's kind of got Republican leanings. There's a guy called Jerome Powell. He is already, of course, a Fed governor. So he's got hawkish leanings, and he's viewed as a potential candidate to take over. John Taylor's an academic. And then you've got this guy, Cochrane, down the bottom, who's also a professor. He's an academic at the University of Chicago. Academics, I don't know, doesn't sound like Trump style to me. I'd say Trump would want somebody who's got industry experience, perhaps. Whether Powell's something, again, that's something I don't think that's very Trump-like. Trump likes installing candidates that aren't already part of the establishment. So, I don't know, maybe Kevin Warsh amongst these lot, even though he was, of course, part of the establishment a few years ago, and certainly was involved during the crisis. At least he's got Republican leanings. Anyway, this is just something to keep your eye on. Not now. This isn't a thing for to think about immediately. But Tarullo stepping down in April perhaps might get this story gathering a bit of momentum. All right, moving on. Other stuff to talk about. Greece are in the news, of course, ever more so, and I've got an interesting chart to show you. This is about, of course, the ongoing discussions between the IMF and the ECB, EU officials, all trying to come to, another extension of the Greek bailout program. It is officially now, we are 7 years into this crisis in Greece. It was January 2010 where Greece owned up and said, look, we've been lying about our deficit and oops, we're going bankrupt. Save us. That was 7 years ago. And here we are still talking about ways to try to save them. It's not only Greece's fault by any means. But look, I'm going to scroll down because there's quite a good chart. Oh no, where is it? Sorry, it's on the next graphic. Here's a great chart, because here's the problem, okay? Let me show you 2017 first. This is Greece's debt due. This is bond redemption dates. This is where bonds mature and they've got to pay back the money to the bondholders. Any one of these that doesn't get paid is a default event. Now, look at this on the left hand side. This is in billions, okay? So you got 3 payments here in March coming that are all between 1 and 2 billion euros. So obviously if you add those up, you're getting up to kind of 5 billion or so. That's quite a lot, but this is all fine, this stuff. And in fact, all the way up to June here, this is already part of the existing bailout agreement. Tranches will be paid. All this debt is going to be paid unless something remarkable happens and the negotiations spectacularly break down. Aside from that, all this stuff's fine. The looming cliff, or maybe mountain, let's call it, is this thing, July. So this is where we do not yet have agreement on funding, and this is where we've got enormous amounts. So we got just one payment, 3.9 billion. Add in a couple of 2 billioners in there as well, and so add in these. You basically got a 10 billion month here. July is a 10 billion euro repay a bill month, and this they currently do not have money for, and this is what they're negotiating. Okay, just to look at this on the long term, all years. This is looking at debt redemption payments over the long term, and what we've seen in previous bailout agreements is you've seen debt relief by way of not only haircuts but also extending the maturity dates out to crazy levels. You're getting out to the mid 2050s here. Look at the colours on this chart. So the colours, the blue is the European Financial Stability Facility. The yellow is the Eurozone governments. Where's the IMF? Sorry, the IMF's red. So you see the IMF payments are all relatively front-loaded. You've got the European Central Bank, a light blue, and at the moment, European Central Bank exposure is also quite front-loaded. But obviously you've got private investors still in there, but as you get right the way out, it's all European bailout fund, and it's all the green European stability mechanism. One thing to note here, giant column here in 2017, but the biggest part of that column is, where does it say on the graphic? Yeah, treasury bills. This is short-term debt. Of course, all of these columns going out, as it stands, do not have treasury bills on them. They will do, though. So it's not like Greece have got a giant column this year and then it gets better, because you're going to have a rolling treasury bill obligation year in, year out. So, of course, these columns will increase in size as we get into or near to that year. So this is debt. This is the debt profile. But as it stands right now, what's it going to be all about? It's all about July. Basically, Europe have got until July. It's not like they've got nothing else on the agenda, mind. We've only got the small matter of a Dutch election, 2 rounds of a French presidential race, and, something called Brexit. But apart from that, we've got plenty of time, right? So this is something to keep on the radar. It's all about July. Moving on. Next on the slate, timeline on Brexit then. Now I've mentioned Brexit. David Davis here. He's expected. So this is just a bit of a timeline. What's happening next on the Brexit front? So next up, Monday and Tuesday, the Article 50 bill is going to get voted on in the House of Lords. Okay, it's already been voted through the House of Commons, of course. Now it hits the House of Lords. This is happening starting next week. This isn't a risk. There's no way the House of Lords are going to reject this unless they're suicidal. which I don't think they are, and so they will vote this through. I don't see this as a problem at all. So what happens then? Because, of course, if they do vote it through, well, Theresa's got her wish. She now can trigger Article 50. So when might she do it? Well, you've got a bill reaching the committee stage in the upper house. This is like formalities with regards to how legislation works. But ultimately, we'll have the third reading of Article 50 in the House of Lords perhaps at the start of March. You've then got actually the budget, so Hammond's going to deliver the budget on the 8th of March, but perhaps more importantly, from a timing, when is Article 50 going to be triggered? We've got a Eurogroup Council meeting on the 10th of March. This is where Theresa May is going to be attending. It's unlikely Theresa May is going to deliver the bad news right in the middle of a European Council meeting, as all the kind of not the, I don't want to call them the enemy, but it will feel a bit like that once Article 50 is triggered and negotiations start. You know, you don't want to be in the lion's den and then, well, I said something to Ant earlier, which I can't really repeat on the mic, but anyway, I'm going to move on. She's not going to, almost certainly not going to announce the trigger of Article 50 on March the 10th. So therefore she's going to wait until after that, and what we're thinking is there's a Commons, we got something penciled in on March the 14th. This is when the Commons could consider any Lords amendments, if there are any, to Article 50, which I don't think there will be, so I'd take that out of this timeline. We're thinking, and the BBC have reported that they reckon the 15th of March could be the date, because you've got a Eurogroup meeting, or Euro Council meeting on the 10th, and then you've got EU leaders on the 25th. And what they're saying is, what might be polite is waiting a sufficient amount of time after the European Council meeting, i.e. 5 days, trigger Article 50 with enough time before the EU leaders meeting 10 days later for people to kind of prepare for what might be the beginnings of negotiations actually at that meeting. So we're thinking 15th of March. This is the latest, all right, in terms of when the Article 50 will be triggered. Of course, Mrs. May, Theresa's self-imposed deadline is the end of March. All right, so that's an update on Brexit. Let's move it on here. Here's someone you might recognise. He's been in the press on the Brexit front still, of course. Tony Blair, rolling back into town, trying to launch a campaign against Brexit. I don't know what your feelings are on this. Some people are Blairites. Some people, of course, are certainly not. But I would say this is, I don't know. I think this is irrelevant when it comes to, is Article 50 going to be triggered or not? Absolutely irrelevant. Article 50 will be triggered. I think where Blair can come in and influence things, if he can gather enough of a support, he could perhaps shape the opposition opinion in Parliament and at least try and get Labour rallying around a central view, and it might lead to Parliament becoming more influential in the negotiation process, because Theresa May has said now Parliament is going to be involved. Parliament will get a vote on the final deal and so on. Parliament will be updated periodically. So if Blair can gather enough support, perhaps he can influence a softer Brexit.
This is with inflation going up, consumers are going to feel that pinch. Perfect play.
So anyway, Blair, keep an eye on Blair, not to avoid a trigger of Article 50. This is more of a medium-term play as negotiations play out. Let's look at the calendar for today. Not much on it other than retail sales out of the UK, 9:30. All right, so we'll look at that before that gets announced. It literally is pretty much empty other than that. All right, so bear that in mind. Nothing much scheduled. What else have I got here? Yeah, on the UK, and that data, and we will talk about this again, but that data is quite interesting given what happened on the December print. This is UK retail sales in December, nosedived, almost minus 2%, matching the worst readings basically since the crisis. Okay, is this, well, really what we want to see today? And if I flick back to the calendar, we've got an expectation for a rebound. We're expecting plus 0.9%. For January, okay? So we've got expectations of a rebound. If that doesn't happen, I mean, when this print came out for the December data, it was like, wow, okay, inflation's ramping higher. Is this the story playing out whereby prices are getting more expensive and consumers are now buying less because they're worried prices are going to continue to rise and they're beginning to kind of tighten their belts and save up? Is that this, or is this just an extra bit of volatility on what is a pretty noisy data release anyway? So we'll find out today, plus 0.9%. Anything negative today, and I think you really start to get people getting even more worried about how damaging inflation might be to growth as we hit 2017. Okay. Final point, something that happened yesterday. I'm going to go back to the charts first, quickly. What we had yesterday was quite a weird move in bonds. I mean, I've got T-notes here first. Given that we had really strong data, and I guess equities sold off in the end, but we had really strong data, and yet T-notes rallied hard, broke up above R1, hit R2. We're testing yesterday's high pretty much right now. Be aware of this price. Again, you could use the same argument. We've had a really powerful downtrend here, and now we're just getting a bit of profit taking, right? That kind of similar example we had for the dollar, that we had for equities. We've had a really strong unidirectional movement across markets that basically yesterday just broke down a little bit. What happened with T-notes on the upside is actually something that happened on the European bond space, I would say. If you have a look now on the Bund, and actually this is probably the worst European bond market chart to show you to give an example of this, but the Bund moved higher yesterday, and this is actually something that came out of the ECB minutes that kind of got overlooked a little bit, and I want to just make sure it's not overlooked. Here is a graphic looking at what's called the ECB's capital key. So the ECB are printing, well, they're still printing 80 billion euros. They're going to switch that down to 60 billion when we get to April. But they're printing 80 billion euros a month, and then they're buying mostly government bonds with that. But what government bonds? Which ones? And their capital key rule means they've got to divide up that 80 billion and spend it proportionally depending on the size of the economy. So Germany gets the most. So the ECB, 26% of the 80 billion gets spent on German bonds. 20% gets spent on French, 17 on Italian, 13 on Spanish, etc., etc. Going down to the smaller guys, right? Now, the problem is Germany, they're running out of German bonds, let's put it like that. They're running out of available German bonds in terms of breaking some of their other rules, such as the yield floor rule, although they've kind of broken that already. But also there's another one where they're not allowed to own anything more than 33% of any one government's bonds. So look, they're running out of German, and these are the ones they have to buy the most of, and it's like, well, hang on, if we can't buy whatever 26% of 80 billion is, let's just call it 20 billion, roughly, which it is just over 20 billion. If they're like, we can only buy 18 billion, let's say, what do we do with the other two? And is this actually a failure of the implementation of our QE program? And what most likely is going to happen, and what came out of the ECB minutes yesterday, is that they can break the capital key rule if they want, temporarily, is what they said. Which means, let's say they can only buy 18 billion of German, well, the 2 billion left over gets spent on the peripheral nation bonds. What you had yesterday was a big rally on Italian, on Spanish, on Portuguese bonds. Big rally, yields dropping. Yields dropped 10 basis points across this space as we're pricing in the idea that the ECB can actually, apparently, ignore their capital key rule, which I don't know. Well, I'll have to look at the last ECB meeting. Was that when he was rotating off? Can you have a look at that, Vas? Was that a meeting where Weidmann rotated off? Because I would say Weidmann would be very anti breaking the capital key rule. But anyway, something to think about. Certainly bond markets reacted to this yesterday. All right, I'm just going to quickly finish with the charts again. T-notes on the break. I'm looking at the Bund here. Bund's breaking. I'll check the T-notes chart. This is a strong move higher on the Bund. Just technically breaking up through the high point we had on the 14th. Just check T-notes because the same thing's happening there, of course. Both correlated these markets. T-notes breaking up through yesterday's high. So just keep your eye on that. If I get the T-notes chart out of the way. We're getting a bit of movement south on equities here. Not as dramatic as the bond market move for sure, but S&P down on the lows. Just looking currency wise, you've had a break lower, dollar strength, so cable down to test that low point from yesterday afternoon, down testing S1 on the futures, euro dollar breaking below pivot on the futures as well. So you're getting a bit of movement on the dollar strength, bonds pushing higher here as I speak. Equities less so. Keep your eye on the DAX though, because we're just hanging around that low point that we had on Wednesday. Right, I'm going to leave you to it. We've got 25 minutes till the UK retail sales data, and we go from there. Thanks a lot.